Okay guys, what we're going to have a look at is strategy life cycle. Now this comes in two parts, life cycle and then also the life cycle of news. So we'll come on to that in a little bit. First up, life cycle of any strategy. Now what this is about is understanding the game at play as a market strategy changes and develops. So what basically will happen with any strategy is you start with a trade idea. Now as this trade idea becomes clear to more market participants, you get conviction and crowding. Now this isn't bad, and you have to understand how this helps, because as more people recognize an idea, this is more people that will push the idea as the move happens. So that makes for a trade that is a more viable opportunity. The problem that you get then is that as you move through the conviction phase and the crowding phase, and one example of crowding is that the moves can become more extreme, and that needs to be thought through in terms of what this means going forward. Because as something crowds, this now takes away some of the edge in understanding the trade, and the edge now shifts onto your execution. So you can still trade it, but you have to appreciate that the edge is now in the execution, and that whilst other people understand the trade, there is now also the other aspect of the necessity to get out of the trade. So you can start to see the trade shifting, which then leads you into the adaptation phase. What happens is once it crowds, it then gets cannibalized, and that's that whole point that people get faster to get on, faster to get out. This now requires adaptation. Is it possible that you could get into the trade earlier? Is it possible that you can look at the trade and have a more efficient exit to capture that cannibalization, that rush of everybody else thinking the same thing? What it effectively does is compresses the value of a trade. Trades will either then adapt into something new or just simply go extinct. And that's the end of the trade. So to try and draw a little example of this, basically what will happen is if you have a move like that, so let's call this 20 ticks. To start with, we'll call it 20 tick move higher. To start with, you may be one of the only people who recognizes this, and then as the move gains traction, more people get onto the trade. So your edge is in the understanding of the trade and the ability to get in right down here, knowing that you can probably get out somewhere up here. Now, as the trade gets more understood and more people recognize it, you can still get in early on, and as more people try to get onto this trade because they now recognize the basics of once it starts moving you buy it, this can overextend and may offer you more ticks. Good news, particularly as you're still getting in right down the lows. But now that this becomes much more noticeable, availability bias, people recognize this, the edge in this gets eaten up because now everybody piles in, meaning that your ability to get filled in the lower part of the trade starts to diminish. So now your edge is less about the understanding of the trade and more about the execution to make sure you're not giving too much up. Likewise, knowing that this now potentially has, say, 30 ticks in it, people want to make sure that they actually get out. And if you know that there's lots of other people participating, you need to make sure that you beat them for your exit. Now, getting out is more important than getting the maximum. Because if you don't get out, you'll never maximize the trade, because what starts to happen is rather than just this be a straight up, it accelerates up and then whips back as people realize that they're chasing it and they now chase to get out. This is how the trade gets cannibalized. You either adapt and you potentially now just start to play the reversal side of it, or you look at getting in before the run up. You try and adapt. Otherwise, the trade just simply dies because people are so fast to get in and so fast to take their profit that the moment that it starts to move, everybody who's buying becomes a seller, and that restricts the move. That's why in simple terms, when you have a large order and people front run it, what happens is you end up with a situation where so many people front run the large order and then try and take one or two ticks that the market can never get away from the large order, meaning that you actually now have more people long ahead of a large bid than you do on the bid. So now effectively, and always think this, the more people that buy effectively now is more sellers. We've talked about this from early stages of the course, but if you have people who are long, they are sellers because they have to get out of their trades. So if you have more people long than the available bid, you've now got the ability to go through that, and that's how a large order gets broken, because people are so quick to try and take their profit, they effectively cannibalize their own trade. So let's go and have a look at an example of this. This is a really short time frame one. This is a trade idea. So this is something noticed in the pound. Big jump in volume. Whenever you have an anomalous jump in volume with no news behind it, you start thinking there's something in this that might be a trade. So you then investigate, well, what happened and when did it happen? 7 a.m. So the turn of the hour, big jump in selling side volume, or certainly set volume and a move down. You actually have delta ticking up, but selling on this move. Okay, so 8 a.m., you now start to think, right, I can go for this. Trade happens again, volume jumps up, you can play the trade. Now, this doesn't offer you a great deal. It only offers you around about 10 ticks, so quite limited in its movement. Note that it goes on the hour and the next minute. This one was on the hour and the next 2 minutes. The trade starts to get crowded. How do you recognize that? Because these ones were sporadic jumps in volume. Look here now, steady build in volume into this. The market is already on the way down by the turn of the hour. People are recognizing the trade and they're crowding it. Everybody's trying to get onto the trade. 10 a.m, it kind of dies immediately. What's happened is the move down into it has effectively cannibalized the sell opportunity. Many people, having seen this go from earlier than the turn of the hour, now start selling, as well as the fact that we're on a continuation move down, ahead of the trade. And so then when you do get the marginal sell, which does happen, immediately people buy back on this. So basically the trade has been cannibalized and then it becomes extinct. You get a slight pop of volume, so people are still trying to play it, but you get no movement. That's the way a trade comes to light and dies over the course of literally a morning's trading. Very short example of that. But it's that thought process of what's the next stage of this that always needs to be in mind. So moving on from the very short term, let's go and have a couple of looks at examples here, and we're going to use the example that I talked about in pattern matching as well. So this is an older Euro Stoxx option expiry example. We did Euro Stoxx option expiry, and one of the things to be thinking about with Euro Stoxx option expiry is this common pattern. And one common pattern that comes about Euro Stoxx option expiry is the bid at 10.50. It's quite a stagnant move, it's not huge, but you'll get 5 to 10 ticks each time. So, trade idea develops. Steady bid on the Euro Stoxx option expiry. This is the trade idea. So we'll come back and revisit this. Okay, so let's go and have a look at the DAX trade that we were looking at in pattern matching. This is the break of the low of the IB. So this is coming into, or just past 8 in the morning, DAX breaks the low. Now, if you're trying to play that as a trade, IB break trade, it's a viable opportunity. So you can get short on this, looking for a continuation lower. Now, as you see, the market goes down for a few minutes and then starts to stall down at the lows. So what you're interested in here is what happens as this is going on. Now, an easy way to kind of illustrate this is to speed this up. So we're now on quadruple speed on this, because what we're trying to understand here is not perfectly the execution. We're trying to understand the trade idea and then how this becomes a trade. So the first time you see it, you may well have played this as a break of the IB. That's fine. You get the break of the IB, the market starts to move towards the downside. All good. And naturally, whenever you're watching a market fall, you're thinking, well, for this to keep on going, as we have just rushed out of the IB, what do I need to happen? Well, I probably need a little bit of consolidation before a next leg of a move. So at this point, we're down towards 56. No reason to doubt this move in any way here. You're quite happy with the trade. Another large order down at the low. Good. That could be like the one that we saw on the break of the IB. All good. One thing that you're always thinking, always forward thinking and thinking, right, well, what might need to happen here? Accepting a little bit of a balance is quite reasonable. You're thinking market can balance out here. Quite happy with that. We've stalled at that large order. But as it balances out, one logical thought is to look at where this balance area is and then try and have a go at selling towards the top of this for continuation. So there we go, we can get short, trades up to 66, 67, that's all good. You now can start to see where the little range is that we're trading, basically 53 to 67. You're happy with this. Now remember, if you think there's a continuation, you're just waiting for further balance here and then the market to keep going. And having seen this, and obviously you know what's coming here, this develops the trade idea. That you're in this, you're looking for continuation, and that's all good, and you're going to be very aware that your stop's going to be somewhere around here, so just below a scratch, and that's fine. What then starts to happen is the market does then start to tick higher. We go back up again towards the sort of 68, 69 area. You're still all right to be in the trade, and you're thinking, I want to see it back below this VPOC now, back below 60. That's really where you want it to go. So this is good, but quickly whipped back up. And all of this is fine. If you are short, you can't be getting out of that. You're happy to leave the trade on. All good. So here we go. Start to tick back up. Holds, holds. You're fine on this. You're starting to go offside. Now you've got to get out of the trade. Now that's a fat finger long there and straight back to the IB. Now, in no way would I suggest that you needed to be long there. But the point here is this develops a new trade idea. You've just seen this trade go completely wrong on the back of this balance. This is very similar to a block reversal trade. So, you've now got a trade idea. In the same way that with that Euro stocks one, as the conviction grows on the trade, you now can start to take this trade on more. You saw it last time, you've now seen the pattern. You're quicker to get in, you're more convicted on getting in, you can push more size on the trade. The move grows somewhat as well. So that's all good. You've got more information, you now know how to take on the trade. So this is the conviction part. And likewise, the next day in the DAX, you get a similar type of movement. IB break once more. So let's go and have a little look at this one. Okay, so here we go. You saw the trade last time, it's an IB break trade again. So same principle, goes through 05, this is the IB low, you want to be getting short here now. So that's now the new play, IB break trade. You saw this yesterday. If you see the same type of flow, which we are seeing now, you can start looking for the same thing again the next day. So all starts to look pretty good. Now remember, yesterday we dropped from about 85 down to 50, so 35 ticks. This day comes in, the pattern starts to repeat itself on the break. So you can take this on. You take it on with conviction on the sell, but you're also aware of what happened yesterday. So you know that when this starts to stall, you may not want to stay in this. This is a smash and grab trade. So you've now got more conviction. You're happy to hold this. As more people then jump on thinking, well, we saw this yesterday and we know what happened yesterday, the moves get bigger and bigger and bigger. So we started to drop. You're holding outside the IB. Continuation now starts to come through the 80s from yesterday, down towards 70. This is where the reversal came from the day before. And you remember that from the order flow, from seeing it the day before. So your conviction is strong now. You're in 40 ticks on side nearly now. All is looking good. Market keeps going through the 60, through 50. This is a much more aggressive move. So having seen this, you're thinking, yep, this is all looking good. You're aware of the necessity for consolidation. The market, as we know, if it gets stretched out, this is nearly an 80 tick move straight off the open. A stretched out market is naturally going to require some degree of balance. So here's your balance point then. You look for the bounce back. You're expecting now balance down here. You've got to be aware that this now could turn. This is what the pattern of yesterday. So you're quicker to get out. You've got the conviction and you understand the trade better. Much quicker to get out, but so is everybody else. The market doesn't consolidate and instead it puts in this steady reversal. So conviction increases in the sell-off and that part of the trade is absolutely there. The reversal starts to change slightly and now becomes a more stuttered move back up. So you get a better understanding of the trade. You've now got more conviction. Now think about what this means for tomorrow. For tomorrow, quite possibly, you are going to have more people looking at this trade. You look at the next Euro Stoxx option expiry, similar type story. And this is now the crowding phase. So where the conviction is, where it starts to get crowded, where it moves into crowding / cannibalization. What's now going on is the move starts just before the option expiry. Tick, tick, tick up, much stronger move. And what's happening now is everybody jumps on it because everybody knows the trade. The move comes quicker, which means your ability to execute has to be more on point as the move starts because there's less opportunity to hang around at prices you want in. And the move is faster and larger in its size. This is good. You execute, you're ahead of the curve, remember, because you understand the pattern. You execute, you maximize this opportunity. But this is a warning sign. And the warning sign is quite simple. Everybody understands the trade now, meaning that next time, people may not be willing to keep buying it on the way up, and they might actually start to get out even faster. We move back to the DAX trade, similar kind of principle. So let's go and have a look at the next one, and we shall see how this one trades out. Okay, so this time, very fast, straight off the break on the IB. No chance to get in. This is where it gets crowded. It's getting crowded and cannibalized at the same time here. And that, these two things do kind of go together. So whenever everybody starts to understand the trade, that extreme early move means that the only way in, you needed to be in as you approach the low of the IB. So that's how you overcome some of the crowding. Similar concepts of these large orders down at lows. So you can have a go at trying to hit into those to sell again. So all good. But now look at what's going on. The crowding's beginning and people are now starting to try and play the reversal earlier than the move actually than the actual move. So the trade still works, but you can see how now it's getting crowded. It's harder to get in at the beginning and it's now harder to get out or get the continuation to get out because people are now already coming in to buy this. So this now starts to limit the move. The Euro Stoxx one provides a large direction. This one, the crowding takes away your edge on the execution to start with and also reduces the trade down towards the end. So you're moving into kind of crowding in terms of the amount of volume going into this trade early on and also cannibalization in the first instance. There's very little chance to actually hold on to this trade. And what is more relevant is whilst previously you get the chance to exit, this time as it starts to bounce, the bounce is ferocious. It gives you almost no chance to get out, very fast reversal back up towards 60, stalls and then turns. So what's happening here is people are crowding this trade in both directions. They crowd it to get short, hence the gap of volume that you get on the break of the IB. Basically, people are just taking everything and all the buyers have got out of the way. And then there's the crowding to get long on playing the upside of the trade as people run for the exit. And also people are now thinking, actually the easier trade is to buy it. So it's always thinking about the gameplay of how people are thinking through the trade as the trade happens, rather than just simply going, well, this is the pattern, repeat, repeat, repeat. Whenever something becomes repetitive, it becomes easy to replicate. And the more people that replicate it, changes the composition of the trade, because it changes the way people have to execute. It diminishes edge. And that's a crucial aspect to understand in the way a trade's life cycle shifts. Now you get the cannibalism phase. What happens here is the move effectively stops working, because people are so quick to try and get on it and so quick to try and get out that rather than that crowded move where the Euro stocks push towards the upside, instead now what you get, up, down, and that's it. Instant, 1 minute and the trade is gone. So this has been fully cannibalized. It still moves reasonable distance, it moves nearly 10 ticks, but that reversal is instant. So unless you were in straight away and out as soon as it jumps, there is very little chance to make any money out of this trade. And this is because everybody is trying to jump on the same thing. It crushes the trade, it crushes the opportunity, and that's what's going on there. Similar story in the DAX. We go and look at this one. Again, the move gets cannibalized. To be fair, it's still quite reasonable on the move down. But like we saw on the previous, the reversal is so quick. So if we go and look at this one now, right, as you can see, once again, DAX on its way towards the downside. So, market's on the drop, drives towards the downside. Now, what's going on here, unfortunately we can't see the bids and offers, but that's not really that important at this point. The bit that's going to be very relevant is the speed of the reversal. Now this is, as I say, the cannibalization phase on this trade. Now if you understand the concept of it, you're aware that if you have played this break, that's fine. But you're thinking about what happened last time. Last time, that reversal, when it came, didn't give that much opportunity. It bounced back and then it started to reverse. So you need to be very aware that if you are short here, the reversal is going to become instant, meaning that you have to think about how you get out. Your reasoning to exit on this trade has to be almost instant. If it doesn't pause, you need out. And that's what you've just seen. We've gone from the mid-30s to the mid-50s almost immediately. That's this move here, instant back. And then up to 70 very, very quickly. So what's gone on is basically that the reversal play that people have been looking at, as well as the short off the open, starts as a block reversal. It then starts to sort of fade out and people start buying it. It becomes a quicker reversal. Then, and that was where it flushes and then reverses. Then people start to buy it and the delta flips and it reverses very fast. And this final one gets fully cannibalized. You have no chance to get out if you're short. Whips straight back against you. And so this is where the constant adaptation of the trade in the moment is so valuable. Because if you're always thinking about the impact that traders are having on the trade, this then changes the way you take the trade on. You could well, in this one, be looking for the reversal. You get some volume down at the low. As soon as it doesn't continue on that, you can now play the reverse on this trade. It's about always thinking about what other people are doing and how other people have been affected by the recency of this move. That's where the value comes in understanding strategy life cycle. Now, what starts to happen with the stocks one is you then see adaptation or extinction. And the adaptation comes, and this is a really common pattern that we've seen in Euro stocks and is repeated many, many times, that after the end of the bid up into the option expiry move, you then get the bid up followed by the no action and roll over. And this rollover move then gets faster and faster and starts to become the sell-off on the option expiry. So it's that understanding of the adaptation and even the sequence of adaptation that can happen with these types of trades. And of course, once you've learnt the trade, and this is what's so valuable about learning a pattern and learning a trade, once you have learnt it, it can resurrect. And as soon as you start to see that pattern occurring again, you're back into that phase. And the advantage here is that because you already know it, the first instance where it shows that type of flow that you already understand, you're straight on it. The gap there between those two trades was around about 3 years. But once you've learned this pattern, you have it forever. And so you learn the skill set and the order flow that happens here that makes this a viable trade opportunity. So that's the idea of strategy lifecycle. And think about this with all of your trades. If you start to see that your edge is changing, that you are moving from an understanding of the trade edge to just pure execution edge, this is telling you something. This is telling you that this trade is starting to die and you need to start to adapt or accept it and move on. You've always got it and you can keep it in your back pocket. It's always going to come back. It's about recognizing that adaptation of environment which factors into it, and also just the life cycle that naturally comes with any trade. The more people that understand something, the less value it has. It will return, and a lot of those people will have forgotten about it. Those who understand the trade deeply are already there at the sharp edge as soon as it comes back. That's the value in understanding strategy life cycle. So make sure you understand that and track that with any strategy that you are trading. Next up, we're going to look at diminishing value of trades. Right then, diminishing value trades. And this, I'm going to use news as the example to explain this. So there are good examples throughout the flow of the Russia-Ukraine crisis, and then also looking at the Pfizer vaccine. The reason I've used this is because it's a fantastic example of how one of the best traders at Trading News executes it along with his thought process. So I'll be explaining that and walking you through that trade. So, we know that with any story, it starts with an initial story. Now, this is the diminishing value of an event. So rather than this being the sequence of a crisis, you have the initial story. This is the first change in a narrative. This is the game-changing move. So if there's going to be a big action, it's here. This is not like a crisis development. This is a game-changing shift in narrative. Then you get confirmation. Not every story has confirmation. Some stories are the story. But you have confirmation. So you get the initial story, which changes the narrative. That's the game-changing bit. The confirmation gives you a bit more. And when we talked about pricing in, this makes a bit of sense there, that it adds to what you already know. It further enhances the understanding of that information. Then you get subsequent information. What happens here is this is where data or story can become more messy. That the more information you have doesn't really change the story in any meaningful way. All it does is it fleshes out the information. And this is where the value starts to diminish. You can, in some instances, get the contradiction of the story, which provides another shift, so an extra little opportunity. But the longer the story goes on for, the less value the subsequent info or contradiction has. And eventually, every instance of a story, of narrative, fades into irrelevance and stops being a big deal. Now, I've got a couple of illustrations to kind of try and explain this perhaps in a little bit more of a simplistic way. What happens with an initial story is that on an initial story, you have a wide number of options. This is totally new. So the market is pricing in all available information, and then you get something new. This creates a big shift. So this takes you from where we currently are to a new piece of information. That's the extreme move. That's the first big one. Now from there, what this provides you with is two fresh points. There is either the completion of the story or the reversal of the story. So take the Ukraine invasion. We got word that Russia is increasing troops on the Ukraine border. This creates a reaction. Every subsequent piece of information moves you closer or further away or shifts you between the two. And these 2 points are basically the extremes of the story. Invasion, no invasion, basically. So every piece of information swings the market from one side to the other. But the more and more information, the less clear-cut the information becomes. And so the less valuable the trades are until you get the next game-changing piece of information. What that piece of information is the invasion, which takes you to here. And now there's a new question, and this is what creates the extremity of this move. That the new game-changing question is not, is there an invasion of Ukraine? We know that. The new question is there now an invasion of Europe and potentially a nuclear threat? That's the big swing. Now, over time, this threat seems to diminish somewhat. So we're now in a situation where as the war progresses, and the more and more that we go through the war, as much as there is a human and emotional impact here, the relevance from an economic perspective diminishes. The war goes on, But we're now sitting in between escalation further to Europe and no war. So this now develops into peace or escalation. And so the actual war itself becomes somewhat irrelevant, and changes in that have less relevance and the opportunities diminish. That's the whole idea here. That 6 months after the invasion, people ultimately weren't reacting to any Ukraine-related story. So to try and illustrate this further, this is what you end up with. What you have here is the green illustrating the frequency of news relating to a story. And this is over time. So over time, you have limited news on it, the first piece of news. There's not lots of news on this, first piece of news. That creates opportunity. Now the opportunities are measured by value. Opportunity jumps up. There is huge value in the first instance. But as you get more and more opportunities, the value of those opportunities falls. Simply because none of them are as clear-cut as the first big shift. This is why when you get game-changing news, you have to go for it straight off, not wait for the next bit and the next bit and the next bit. The more information you have, the more shades of grey you're getting. You have a little bit more of a clearer overall story, but nothing's really changed from the main story. You just have better detail. To the point then, the value completely drops off, and as the news story disappears, that completely drops off, which now leaves you in a new potential scenario. We could effectively be back here. That a new shift in the story can become very significant in its value once again, because this would then be game-changing away from where you currently are. So this is what then happens. Phase one is the will they, won't they invade. So that is then the steady progression higher and the realization that the invasion's coming. Then the invasion happens. That's the game-changing impact that creates that one big opportunity and moves you into the next phase of news. The next phase of news then takes on an extra element that there is a nuclear command threat in Chernobyl and also nuclear threat from Russia. We get sanctions on Russian oil. So this is all played out in oil market. Of course, that's the obvious place to go. And from there, you get huge ramp up as the story gains traction. We get nuclear threats, we get sanctions on Russia. All of this limits the supply of oil, and so feeds into this extreme volatility. Then you get the peace talk idea, and there's a beginning of some attempts at peace talks. Now over time, these die off, no peace is given. But what you have is a stabilization, at least of the story. The story is clearly becoming a point that this is not necessarily escalating, neither do we have peace talks. So that doesn't necessarily drop the price all the way back. But what it does do is stabilizes the story. And as the story stabilizes, the volatility compresses and the opportunities disappear. There's still an opportunity that will be prevalent until you get one or another of either peace or escalation. And until you get that, that's the only big story in this. And the relevance of the story diminishes to irrelevance. Not very comforting for those part of the war, of course, and I appreciate that. But from an economic and trading perspective, the story has now become irrelevant by the time you get the in-between peace and escalation until information shifts one way to the other. 6 months after the story, there is no shift. So therefore, the story becomes irrelevant. So let's go and have a look at an execution trade on this. And this is looking at the potential of a vaccine post-COVID. Now, this is a scenario trade where everyone knows that this is a big deal. Everyone knows the potential of a vaccine. This is the silver bullet. This solves all the problems. Now you can template this, and templating things is very important to understand market reaction. So the first template you have comes from around about May 2020, and the talk of remdesivir being used as a cure, or at least a treatment for COVID. Markets react very positively. This is the move in the DAX on that story, gives you a gap up and a full 500 tick move over the course of the day. Very, very strong. Markets clearly like the idea of a vaccine. Of course they do, because what does a vaccine mean? The economy can open up, people can spend money, things can get back to normal. Positive signs. So we all know that this story is out there, which now allows you to plan for the potential. As more and more drugs get tested, you can start to build a scenario on this. And the scenario quite simply is, if there is a viable drug, this effectively opens the economy and provides the silver bullet. that is, from a market perspective, seen as the solution. Of course, for some people, from an emotional perspective, that's not necessarily the case. I know this firsthand. I know people who died very close to me. It's not a nice experience, but you have to, when you're a trader, take that bit out of it and trade the market reaction, the market's perspective of this. As hard as that may be personally, you have to understand that side of the trade. So, going into this, what you know is that Pfizer is going through the final stage of testing. And we know the information that you need to find out. And basically, there's three key factors. Safety, i.e., is there a risk of it harming people? Efficacy, does this actually cure the disease at a high rate? And also consistent standard of manufacturing. These were set out by the FDA, so the US Drugs Testing Agency, as the criteria to allow this drug to get to market. Specifically, what they stated is that a vaccine with 60% efficacy would be good enough for approval. So now you have a benchmark, which allows you to form trades. You know that this is a big deal. The first vaccine is major. So, based on your scenario, anything with better than 60% efficacy means basically that the population can be immunized, we can move out. Now, markets price this in. So what that means is, whilst not everybody is immediately going to be immunized and immediately saved, this is priced into the market because effectively this now means that the economy can reopen. Maybe not immediately, but you price that in ahead of time. So you have to also understand what markets to trade, of course. And this is to do with the sector impact. Everybody planned and knew that value stocks were going to be better than tech stocks. Why? Tech stocks have performed very well throughout COVID, simply because people could only buy stuff online. So the tech companies performed very well. Value stocks, less so. So what we're interested in then is high efficacy is risk on, low efficacy is risk off, or below 50 is risk off, and your market selection crucially needs to lean towards the markets that are going to be most affected by this. Equities are the obvious place because they're the barometer for opening the economy. As a second wave on that, people are going to trade the risk off, the risk on side of the trade as well, bonds and gold. But that's going to be a secondary decision. The main plan here needs to be a shift towards things like the Russell, the Dow, the DAX and the S&P. Note, nobody is going to touch the NASDAQ on this, simply because of the issue with tech stocks potentially turning, because where they have commanded the whole market, that share is going to start drifting to other stocks now. And that's why nobody's going to touch the NASDAQ on this. So, the news comes out. Pfizer say their experimental vaccine would be over 90% effective. This is the moves you get. S&P up, NASDAQ up, and reverses. Massive. Gold was arguably the biggest move on this. Gold puts in 1,000 tick drop on this. And this is on a 1 minute chart. Half of that move, just over 700 ticks, is done in 5 minutes. That's the significance of this game-changing news. The S&P on this moves around about 100 handles in 3 minutes. That's the scale of the story, whilst the NASDAQ jumps and turns completely over on this. So, very, very significant shifts. I'll bring the ladders up and I'll explain what goes on with this and how the news is interpreted and executed upon. So, here we go. What we've got here, the news hits. We know, or there's an expectation, that 9:45 could well be the time that the news is going to hit. So, the plan is, S&P got that ladder up, as with the DAX, and then got other risk ladders, and gold. The story comes out, 90% effectiveness. That's the information. Nobody needs to know anything else. As soon as you see that, you know what the trade is. So, the story hits at 45, so just hits. As soon as the story hits, the plan is hit the S&P and hit it hard. So 400 lots into the S&P. Now comes the tactic side of things. Having hit the S&P, there's an opportunity now to hit the DAX. There's 150 lots sitting on the offer. That's great, because now you can go and hit that. So, hits that, 90 lots along the DAX now, and that's down at 740. So just to give a sense as to where the early entry points are, 740, and that's 12,740 in the DAX, and the S&P 35.55 approximately as the first entries on this trade. Once on side in both of these, so 30 ticks on side in the DAX, around about 25 handles in the S&P, hits the Dow, so gets another 150 lots into the Dow. So now, across the board long equities, on side in everything equities. Because this is game changing and it is a risk on move, the first thing to do is the equities, and then it's an attempt to go and sell bonds. So then goes over to the bond markets. Bonds as the first place, and also then considering 5 years or T-notes on this as well. Now, ticks offside, that's okay. Remember, it's a long, long way onside in these, and it's starting to scale some out. DAX has barely scaled anything out, and is around about 80 ticks onside on 80 lots. So P&L starting to push over 500,000 on this trade, still starting to just steadily get out. Remember, this is game changing. So when it's game changing, the objective is not to go rushing for the exits here. Of course, it's about reducing size, and trying to bank something out of this, but the objective is not to go running for the exits. So happy to now add more to S&P. S&P now, white boxes, limit up, or not limit up, but volatility stops, I should say. So somebody's basically come in and smashed the market long. This creates a volatility stop. How do you hedge that? You can buy more in the DAX. So the DAX is around about 100 ticks on side. You can buy more now. So as the S&P volatility stops, the plan is now hit more DAX. So it hits more DAX on this. DAX has now moved a full 100 ticks. S&P still, realistically, the S&P still only moved about 30 big handles, or 30 handles on this. Not loads, and now the bonds are starting to tick on side as well. So DAX is decent distance on side. The S&P continues to tick higher and higher. The bonds are continuing to move further towards the downside. Everything's continued to tick in the right direction. And so now, got decent distance on side. We're about 2 minutes into the trade now. So now it's more an objective of steadily getting out, particularly of the equities, which have now started to put in some very, very large moves. DAX is up 150 ticks from where he entered, let alone where it was at the beginning of the move. So DAX has now done 250 ticks. He's actually got into this trade nearly 100 ticks higher than where it opens. P&L's hit 1 million, and he's also starting to now think about the impact of the NASDAQ. So this is understanding his thought process in the trade. He's starting to think about the impact of the NASDAQ. If the NASDAQ starts to turn, logically it should, but if it starts to turn, one of the implications of this is of course going to be that it is going to drag on the S&P. So the S&P is going to be limited in the upside because of the NASDAQ reversal. So if the NASDAQ starts to turn, it's time to get out of the S&P. And that's the thought process now, to try and wind this position down. The bond markets and gold are happy to keep going. The reason that they're able to keep going is they don't have this two-way pull on them. The bond markets are on the way up, are on the way down, and there's no real reason for any change in bond markets. This is a risk-on move. Bonds should be coming off. So short 30-year, happy to be short bond, and now just steadily exiting these, but starts to scale down the Dow, the DAX, which is now 200 ticks on side, and the S&P, which is now around about 50 plus handles on side. So this is the whole point of looking at the NASDAQ. Never intending on trading it, but the indication you're getting from the NASDAQ here is that this could well be at least a short-term end. As the move is absolutely game-changing, then what that indicates is that this is this is a major move, and you need to now start to bank something on this. Part of this is P&L influenced. We always say don't be P&L influenced, but in certain situations where the story is game changing, you don't know how big a deal this can be and how far it can go. So in that case, there is an element of once you pass a certain P&L, there is value in now banking this. So I talked about this with P&L management throughout the day. This is approaching record levels of P&L. There is a value psychologically to make sure that you don't fall back from this too far. And so now the objective is about just winding this down, getting out of much of this trade to try and keep the P&L up, which he does achieve, finishes the day off over 1 million up. And that's the end of the day. It basically starts to wind down all of the equities from here. That's the end of the trade. The bonds do keep on going in the end, and that's then what gets you out of the trade. But this is the first game-changing story. This is the big one. If there's ever a piece of news that you're going to really make your money on, it's this one. It's about knowing the value of that. The first change is the one that's going to matter. That's the biggest opportunity. Subsequent opportunities lose value. So if we go and have a look now at the results of all of this, there's the big move in gold, which is a structural based move. Nobody was trading gold because everyone focused on the equities, but this then brought about opportunities the next time because people understood that gold clearly is still very reactive to this. But this is also important. This is one of the junior traders' execution on this. and hits multiple markets, hits the DAX, stocks, S&P, 10-year, Buxel and Bund. But note here that the smash and grab element that he takes gets him out very quickly again, and in the Buxel super fast, Bund as well. The only trade that he really carries well is the Euro stocks. Now, he has a great day, but there's an element that this idea of getting out quickly, whilst valuable in some markets, and the point of trading multiple markets is to get out of some to allow others to go. But instead what's happened, he's got out of everything so fast within the first minute that he's actually then missed the opportunity to carry. And the only one that's really carried here is Euro stocks. And that's a really important thing to understand. The point of hitting multiple markets is to make sure that you can carry some of the trade. You can keep some of the trade on. And if you're not doing that, then you're in a situation where you're not maximizing the opportunity. So that's an important take from a junior trader on this. What this then leads to is the next element. The problem with the Pfizer vaccine is that it can't be stored at anything less than 40 degrees. That's a problem in transportation, in the ability and the efficiency of this to actually vaccinate people en masse. So there's a slight problem with this, which does lead to an opportunity. But remember the point here. There is a vaccine. That's the game-changing story. Now, confirmation or improvement on this story is not really going to create quite the same movement, simply because when the Moderna story comes out, they're only improving something that we already know. The big story is in the bag now, and that's what's going on here. So, what you're thinking about for Moderna is what's already priced in. Vaccines available, so so recovery is on. Good news. We know the types of movements that we saw last time. So how can the Moderna story be better? The efficacy is not really going to matter, so it's about understanding and isolating what the key information is here. The key information on this is the shelf life. If this has a high shelf life, this is an improvement. This now makes the viability of administering this and scaling this out much, much better. So that's the bit of information that everybody is after. Now, we know what the reaction was, so everybody can start to now plan for the future as to what markets they're going to hit. The plan, of course, is now to hit the S&P and arguably to have a go at fading the NASDAQ. Use the S&P bid to pull the NASDAQ up on the positive news, and then the understanding of sector rotation to sell the NASDAQ. So you could effectively get a spread on here between the two. That's going to be one strategy. So that just gives you a sense of the relative movement. Russell actually went limit up. So that also becomes a prominent market for people to look for on this, to trade the Russell, arguably a sell in the NASDAQ, but only after it has gone up and turns, the Dow and the S&P. So they're the first places to be going. The other places, of course, are the DAX and stocks, which were hit very hard by COVID because of the impact on Europe, and the bond markets. Bonds are quite clean because this is just a risk on play. So there's no reason for the bonds to have any rotation between them on this. So bonds arguably become the one that people are looking for. The other options, of course, are then gold as a risk play, WTI, demand can come back and oil can go up. So if you're thinking about where the opportunity is that is not going to be quite as crowded as something like the S&P or the DAX, you can then start to look at things like WTI, a weakness in the dollar. And the reason for the dollar weakness is to do with the fact that people no longer need the QE in quite the same way. Arguably though, currencies are not the place to be because this is a global improvement. So in a global improvement, why should the euro be marginally better than the dollar? And that's illustrated in the size of move. 40 ticks is nothing compared to 200 ticks, compared to 1,000 ticks. It's a complete different scenario. So what you get is a better defined trade on the Moderna story. Now we're not going to look at the video release of the Moderna one, but people know where they want to go. Even though the move is not so big, there is a better defined trade on that Moderna release. People look for gold. And again, similar principle on a smaller scale. This is a sweep of range. The previous one, gold swept this whole range here. This is still a principal sweep of this range. So it's not so big. It doesn't give you the gigantic move, but it is still nevertheless 250 ticks on the first move. So they're more limited, but they're absolutely playable. Going back to the point of strategy life cycle, because everybody understands the strategy in the NASDAQ, this reverse is much quicker. Spike up, spike back, spike up, and straight down. There's not even the slightest continuation in reversal. It's a straight away reverse. Stocks is straight up and the move dies quickly. S&P very choppy. And that's because of the speed with which people are trading the NASDAQ. So arguably this uncertainty between the two is a reason to actually not trade the S&P in this situation. Gold, decent move again. Oil, somewhat tricky in the early stage of the morning. On the story, of course, oil goes again. So this was the morning movement in oil on some sort of preemptive moves of a story. Tricky one to trade. Bund and T-note, again, same move as previous. More limited, but you know what the move is. And arguably these are the ones that are perhaps going to be easier because there's less competition on these. Most people looking at gold and the equities. But even gold over equities is a far more comfortable trade. So you see the reaction. This is all about understanding what happened last time. And I think this is illustrated very well when you go and look at the performance on these. This is the performance on Pfizer as a group. So decent selection of traders, performance on Pfizer. All done in Bund and the S&P, and it's a huge performance. This is the performance on Moderna. Bund, losses in gold, losses in S&P. S&P, remember, was extremely choppy. Gold losses, I think, perhaps trying to get more out of it than was arguably there. Now, when you go and look at a junior trader versus senior trader on this, again, similar type thing. The junior traders do well. Senior trader does very well out of it, and that's obvious. Of course, the senior trader has more scope to make money, but look where the money is made. Junior trader in gold, in Euro stocks. Senior trader in Euro stocks and in the S&P. It's a very distinct difference in the way that they've attacked this. Where I have found consistently is junior traders are much better and much more equipped at recognizing where where the more efficient trades might be, and where they're going to find these trades easier to take. And so looking at things like Euro stocks and gold as their opportunities rather than going for the more traditional S&P type trades. If you look at junior versus senior performance on this as well, what is quite key is that what you get here is senior performance extremely strong across the board, junior performance losses in the S&P. This is the one on Moderna. Losses in the S&P of trying too hard to trade the S&P on this one and not going towards the Bund in quite the same way that they were. The point here being, and this is really important to understand, but it's not perfectly illustrated by these statistics. Where the senior traders did very well was maximizing the opportunity on Pfizer. They did not do so well on Moderna. The junior traders, however, did exceptionally well on Moderna and less so on Pfizer. The reason being is not that Moderna offered more opportunity, but they learnt the lessons of the Pfizer story and implemented them quickly. That's a crucial lesson. And what this should mean now is that they have the skill set for future game-changing news. Now you've seen that, so you're now in a much better position to be able to understand that. The key thing, and one of the big takeaways always to remember, is that the first piece of news is game-changing. And the first piece of news is the opportunity. But it's only an opportunity if you understand the value of that story and you understand the trail off in the value of news. You have to make that news count. That's where you get the greatest value in a trade, and leveraging those opportunities up is the difference between people who are not going to perform over the long term and people who make the most of those one-off opportunities. This is an element of luck that the opportunity comes your way, but it's the people who maximize that luck are the people who survive best. Right, that's the last bit on life cycle, on diminishing value of story. I'll wrap it up there.